What's up, everybody? Welcome back to Trades and Gains, and I'm your host, Max Pitts. And as always, we're powered by Investor Central Club, as you can see. Oh, wrong site. As you can see here. So this is Investor Central Club. This is who we're powered by, and this is your weekly outlook report from your favorite market analyst, Mr. Max Pitts. So let's go ahead and just start here. The Dow Jones just cleared 50,000 for, the first time ever. Let that just sink in. We've got layoffs hitting levels we haven't seen since 2009. We have job openings rolling over for the first, crypto nuking itself last week, and software stocks getting absolutely smoked. And somehow the Dow is out here ringing the victory bell like we just cleared inflation.
Daddy chill. Daddy chill.
Is pretty much what the mood on the market is right now. But somehow the Dow is out here ringing the victory bell again and again. So this is why markets confuse people, because the market isn't saying everything is great necessarily. It's saying we like this version of the economy better than the other one. This week is where we find out if that bet actually holds up. Because now comes the stuff that actually matters. The delayed January jobs report, CPI, and the back half of earnings season where excuses stop working. So let's go ahead and break down what Wall Street is really watching and what actually moves the market. So let's go ahead and zoom out for a second. We're not in a bull market euphoria phase. We're not in a crash. We're in a sorting phase. Here's what last week told us. Dow, all-time highs, means old economy, cash flow, defensives. Nasdaq, fourth straight losing week. Expensive growth is just under pressure. And the S&P, it's stuck in the middle like that kid named Malcolm, waiting for macro confirmation. The translation, this market is asking one question and one question only. Can earnings plus slowing inflation carry us without AI hype doing all the heavy lifting? And that's why jobs and CPI matter more than almost anything else right now. Now let's talk about Wednesday first, right? Because this jobs report is late, but it's not irrelevant. Consensus expectations, payrolls are expected to come in around 60 to 70K. Unemployment at 4.4%, and wage growth cooling toward 3.6% year over year. Now zoom out. ADP already told us private payrolls barely grew. JOLTS told us job openings fell to pandemic era lows. And Challenger told us January layoffs were the worst since 2009. That's not a collapse, but it is deterioration. And here's the key nuance. This is a low hire, low fire economy, as I've been saying for weeks. So if you're new to the channel, well, that's the state we're in. If you're an OG of the channel, we have been seeing this pretty much for every print in the last, 6 months. And that matters because the Fed can live with slow hiring, but the Fed cannot ignore accelerating job losses. So Wednesday's print isn't about the headline number. It's about trend confirmation. The market reaction setup would be soft but not awful, which equals bullish for rates, supportive for equities, right? Weak plus wage pressure equals risk off and, tech pain. And surprise strength, that would cause rate spikes and the Nasdaq to get absolutely smacked like someone who owed me some money. Yeah. As ODB would say. So let's talk about the boss fight CPI on Friday. Expected 0.3% month over month, 2.5% year over year headline, and core is drifting slightly lower. This is where the Dow at 50,000 either makes sense or it just makes you look insane. Because right now, markets are pricing more 2026 rate cuts, the Fed is signaling slow your roll, and inflation is cooling but not dead. The CPI answers one brutal question. Is inflation behaving or just taking a smoke break? Kind of like I want to do right now. If CPI cooperates, yields ease, long duration tech stabilizes, and last week's sell-off starts looking like a reset, not necessarily a trend. If CPI surprises hot, rate cut hopes get pushed out, Dow leadership widens, and Nasdaq becomes the funding source again. This is not about one data point, it's about whether the Fed's higher for longer posture still works politically and economically here. Now, let's talk about the most misunderstood part of this market, the Dow versus Nasdaq split. People keep calling it rotation out of tech. That's lazy. Lazy. What's actually happening, okay? Listen to this. It's a rotation out of duration, right? We have high multiple software, AI names priced for perfection, as I mentioned in multiple not rate cuts, but earnings reports last week. If you watch my earnings corner videos, crypto as a liquidity proxy, yeah, they all got hit like a 1950s housewife. Meanwhile, industrials, staples, financials, and energy, well, they kept working. That's not bearish. That's what we like to call good old late cycle behavior, brother. And markets are saying, we want earnings now, not promises later. Meaning, as Jerry Maguire would say, show me the money. So, this week tests whether that rotation pauses, accelerates, or violently reverses and destroys everybody's portfolio, especially if software names try to bounce after being obliterated. Now, here's the uncomfortable truth. AI hasn't failed, but the free pass is over. Last week taught us one word: CapEx. Yeah. Woo. Markets don't care that companies are spending on AI anymore. They care what they get for it. So it's like, yeah, I gave you $100 to go get groceries from the store, but if you came back with magic beans and I have a big beanstalk in my backyard, I'm gonna be pretty pissed off when I told you I wanted a Salisbury steak, right? Right? And this is why Nvidia was held up for a little bit. Hyperscalers were wobbly, like they were just getting their sea legs back, and software got destroyed. Investors, well, they are asking the important questions right now. Where's the revenue? Where's the margin? Where's the operating leverage? This week's earnings help answer that, okay? So even though mega caps mostly reported this week, is still loaded. On the consumers and staples front, we have good old Coca-Cola and McDonald's, right? Because who doesn't love themselves a good DC, Diet Coke in the morning and a double cheeseburger to clog them arteries bright and early? Or, like, who doesn't enjoy paying like $7 for a hamburger that if you leave out for more than a couple days, it literally turns to stone? Bring the dollar menu back. Stop doing caviar chicken nuggets and all this other crap. Just bring the dollar menu back. That's all I want. And the dollar drinks too. I just paid $2 for a large Coke the other day. Get it together, McDonald's. I don't even eat your food anymore. But these consumer and staples, they're going to tell us something important. Can pricing power survive slower growth? On the cyclicals front, and no, I'm not talking about mental illness. We have Ford, industrials, and materials. These tell us, is demand slowing, or is this just the new normal? On the software and data front, we have Datadog, Cisco, Shopify, and AppLovin. And no, I'm not talking about Cisco, the guy who made the thong song. We're talking about Cisco, one of the biggest tech companies ever. All right. These are sentiment landmines. Any sign of stabilization equals a violent bounce, and any weak guidance, well, that's just going to be a case for more blood, right? And then on the financials and trading side, we have Robinhood, Coinbase, and Market Access. These are going to go ahead and tell us, is volatility creating opportunity, or is it just killing the risk appetite? So structurally, the S&P bounced near about 6,900. Resistance is living near 7,000, and seasonality gets trickier mid-February. This is not a full send tape. It's a selective aggression tape, which Printing Tendies has been doing an amazing job of. And from what I've seen, what he's been posting on X, go ahead and give him a follow if you need some motivation or ever feel like you're doing enough. Barbell setups, well, quality growth that actually earns, and defensives that don't implode if rates stay high. What you don't want are crowded beta names, hopium trades, where it looks like someone just gave themselves some post-nut clarity in the bathroom before deciding to hit the buy button, and anything priced like rates are going back to zero. So let's go ahead. Talk about the vibe check for the week, babe. What's the vibe? You know, I sound like one of those Pinterest girls. Oh my God, I love your vibe. Anyways, the Dow, it's at 50,000, and it isn't optimistic. It's preference, okay? The market is choosing cash flow over dreams, resilience over hype, clarity over stories. This week is going to go ahead and decide whether that choice was smart or whether growth gets its seat back at the table. We got jobs on Wednesday, CPI on Friday, and earnings in between. Same market, different rules, and as always, the loudest narrative will lose. Anyways, I'm Max Pitts with Trades and Gains, powered by Investor Central Club. Use that code SUPERMAX20 for 20% off your first month, and I will see you guys next week, or tomorrow. I'll see you tomorrow. Or if you want to come hang out right now, I'm live on Twitch at Free Wi-Fi, or twitch.tv/Free Wi-Fi Radio. So hopefully I see you guys over there. Anyways, hope y'all have a great rest of your day, and I will talk to you later. Bye.